And first, I would just like to introduce my co-hosts, Ed and Lucas. And our guest today, Som, who is the founder and chief investor at Quantbase, which is the first ever robo-advisor for all things high risk. Quantbase is in early innings, but has raised a $500K pre-seed and gotten $70 million in user commitments for its January 2022 launch. So welcome to the show, Sam. And if you would like to add anything about your background or Quantbase, feel free to speak.
Heck yeah, thanks, Roger. Really excited to be here. Big fan of Ed, and really wanted to meet the Squiggly team. So super happy to be here. So a bit about me. I'm a college student from the University of Virginia on a gap year. We'll see if that turns into college dropout based on how Quantbase goes in the next couple of semesters. So I come actually from a pretty deep value investing background. My first ever book on finance was Ben Graham's Security Analysis. And so for a long time, I subscribed to Warren Buffett's mindset of, buy super cheap value stocks and go on from there. But a lot of things I think are happening in the financial space that make it seem to me like everything is investable. It's like the global financialization of everything. And you really can't get alpha. You can't get like deep research into everything. And so really, I think the best you can do is get beta exposure to all this stuff. And that's kind of the mindset that's driven me to build Quantbase. Essentially, what we're starting off with is high risk kind of beta exposure to high risk communities like Wall Street Bets, as well as like high risk assets like NFTs, cryptocurrencies, etc. And I guess the 10-year vision for Quantbase is to be really the vanguard for everything.
Awesome. Yeah. Thank you so much. I think Ed might have some questions about crypto and NFT investment first. So Ed, maybe you can start asking the questions.
Yeah, absolutely. Som, thanks for joining us today. So obviously you've created a couple of ETFs tracking more traditional quantitative investment strategies, but also I've noticed that you're pretty active in the Web3 community. So would love to just pick your brain a little bit about how we can start thinking about this new landscape from an investor perspective. I have a couple questions, and I'll just start from the top. The first one is I'd love to hear about your crypto strategy. I think the last time we talked, you mentioned interest in creating a couple of ETFs to track cryptocurrencies. So the first part of that is why do we need a crypto ETF, and how would you weight it? What coins would you include? And how should we think about indexing cryptocurrencies?
Yeah, that's a really, really awesome question. And I'm super excited to talk about this. So essentially, I'll tackle like why do we need a crypto index first? I guess the market reason for it is you want exposure to the crypto industry, right? Or to crypto as an asset class. And I think we're seeing more and more with like talk of the metaverse, with like Sandbox, et cetera, being on like multiple chains. I think Uniswap switched to Polygon literally a day or two ago. What we're seeing is the crypto universe is maturing a lot more, and just getting Bitcoin, getting Ethereum isn't giving you exposure to crypto as an asset class. Just like getting Apple, Tesla, or Berkshire Hathaway isn't going to get you exposure to stocks as an asset class. So from that kind of academic, theoretical, hedging perspective, it's to give you exposure to crypto as an asset class. Secondly, and this is kind of what interests me a lot, Bitcoin on a good day will pop 10, 15%, which is amazing, right? It's one of the most mature cryptocurrencies. But then you've also got like currencies that are still in the top 30 or 40 coins that will maybe jump 200, 300% in a single day. And that's kind of the magic of crypto. And I think it's unless you're like mired in the space 24/7, like kind of I am, and like you guys at Squiggly are, it's hard to figure out what to get invested in. And so what a crypto index fund does is it expands your exposure with relative ease. And so, for example, one of our flagship crypto funds is the Crypto 30. So it exposes you to the top 30 currencies by market cap. And so what that means is, like, your 30th coin, it's obviously not going to be a big chunk of the fund, maybe 1% to 2%. And so if that goes to zero, like, maybe some projects do in crypto, it's not a huge effect on your portfolio. But if it does what many small cryptocurrencies tend to do, and 2, 3, 4x's in a day, that's awesome for your fund. So I can talk a little bit about our crypto kind of index fund creation strategy. If you look at it from a market cap perspective, it's really not that exciting. Bitcoin makes up 56% of the market cap of the top 30 cryptocurrencies. Ethereum is another 25%, and the others take up less than a tenth of a percentage point. Obviously, that's not what you're going for in a crypto index fund. So what we've done is we've created kind of a proprietary indexing strategy where we're overweighting some of the smaller coins based on some other factors like volume and just the trust of the coin, and then underweighting your top 5 cryptocurrencies so that you do get real exposure to some of the smaller ones.
Yeah, no, that makes a lot of sense. It seems like there's really a need for the average investor to get into this crazy fast moving space. The next question is probably on everyone's mind, which is, how the heck do we think about meme coins? I'm sure you've been following. I know Lucas and I have been pretty religiously. Congressman Brad Sherman talking about the risk of crypto being crypto itself, and he mentioned a non-existent mongoose coin. That day, the currency was created. A community, a highly active community was created. A roadmap appeared overnight, and there seemed like there was actually a product being built. So how should we think about meme coins broadly? And I don't know, I guess take this question wherever you want. I'm curious.
Yeah, and Ed, you're an early investor in Mongoose Coin, aren't you?
Yeah. I don't know.
Yeah, I guess meme coins are really where where indexing makes a lot of sense. I think by the nature of memes, you never know what's gonna pop off, which one's gonna go to zero immediately, or which one's gonna in the case of Shiba, which one's gonna do 90 or 900,000%. And so an index which kind of allays your exposure to a bunch of coins just makes a lot of sense. So when I'm thinking about meme coins, I think I kind of subscribe to that mindset that, there's not any cash flows coming from this. It's it's a joke. And people are just, throwing their money at something funny. But I think that's a valid, I think if you think about them that way, and then your resulting mindset is they're gonna fail, that's the wrong mindset. I think you can think of it as a joke and as just kind of this funny thing, but at the same time, understand that that's how crypto works, and that's what is working. I read this article a couple of months ago about how somebody bought this Doge NFT, fractionalized it, and then sold it fractionalized them into 10,000 pieces, and then sold each piece of that NFT for more than a 10,000th of the original price. And the reason that took off was people thought it was funny. And so there's real alpha, there's real value in being funny. And I think the reason for that is you're connecting with other people, and that's kind of where the value in things like this are coming from. It's kind of a tongue-in-cheek kind of I guess that's the idea of a meme, right? You connect with other people, make funny things, and have a good time, and now there's actual financial incentive to do so.
Yeah, I think that's really interesting coming from your deep value background. Maybe that, meme coins it's not that they don't have any value, but rather the real value is in humor. And maybe that just makes community. So I guess the last question I have on kind of Web3 before I turn it over to Roger to ask more general finance questions is NFTs. These are really interesting assets because on one hand, you could think about them like art, and art itself is an alternative asset class. But at the same time, these are projects that have roadmaps and teams. So in a sense, you're almost like betting on a startup and joining it at the same time. So how do you think about NFTs as an investment? Is it a right comparison to say that they are pieces of art, to say that they are moving communities and companies? Overall, how should we be thinking about and maybe valuing NFTs?
Oh, yeah, I love that question. My kind of thinking on NFTs is still developing. I've been in the space a lot shorter than a lot of other folks since probably like August or like July or August. So the way I'm thinking about it is there's a formula for everything. And I think, Ed, I'm sure you're familiar, in the stock space, the way that like companies are valued is based on like their the discounted value of their future cash flows, right? But that's just kind of the story that investors have subscribed to, right? The idea that you and I as equity investors believe this company is worth a lot of money because we assign value to cash and want to invest in it now. But like with companies like Tesla, GameStop, even AMC to an extent, you're assigning value not to their future cash flows. I don't think anybody thinks that like AMC is going to be printing money like Apple is in the next like 5 to 10 years. But you're assigning value to a story. You're assigning value to a community. Like you're willing to pay a premium to be a part of this community. And literally, that's exactly what early kind of stages of NFTs are, right? Like the Bored Ape, like the BAYC, you buy an ape to be part of this exclusive community because you get value from the interactions with the other humans that are in that community. I think there's a lot more going on with NFTs outside of art. Like I think from what I remember, like the ENS domains and like Solana domains, they're a form of like non-fungibility in the sense that like when you buy a domain, it's obviously non-fungible. Like you can't make other versions of that exact same domain. And I'm seeing so many super, super smart people working in the space that I'm really, really excited. The thing that worries me about NFT investing and like all the cool stuff that's going on with NFTs is that I think SEC kind of regulation of the space is inevitable. I come from a space that's highly regulated. Quantbase had to create like an RIA, that's an investment advisory firm, because we're working with equities, and because of the nature of our portfolios being high risk, it took quite a while. It took upwards of 6 months to get it off the ground. And right, like if somebody wanted to focus on just crypto and NFTs for what we're doing, they could get this off the ground in a week. So what my thinking is that the SEC is going to be regulating this stuff within the next year or so, and I'm not really sure what's going to go on there. Like I'm really curious to follow the space.
Awesome. Yeah, thank you, Som, for the very detailed information and analysis on the crypto and NFT market. I guess next, I just have a few more basic questions, maybe more representing like the average audience that might listen to this show later on. So, for example, let's say I'm just a college student or like a young professional who has, I don't know, let's say just $1,000 or $2,000 in a bank account. And if I go to the getquantbase.com, so what is the user experience going to look like? And I guess how does it compare with other popular like retail investor platforms like Robinhood, maybe?
Oh yeah, that's a really good question. And while we were doing our investor pitches a couple months ago, we talked a lot about the competitive landscape. So I can kind of walk through that roadmap. The kind of platform or the landscape that we put ourselves on is the footing with like Vanguard, Titan, ARK Invest, certain ETF platforms, etc. So I'll start with the lowest risk platforms, and that's Vanguard, Schwab, your legacy ETF platforms. They're just, they're behind the grain on a lot of this stuff, right? Crypto has been out for years. Vanguard still hasn't gotten like a large position in the crypto space. I think it was Schwab that said that they aren't touching crypto or like putting crypto ETFs or et cetera on their platform for the estimable future. And so they're clearly not the space for high risk, and investors aren't going there to get exposure to anything high risk. And then you think about platforms like Betterment, Wealthfront. They're robo-advisors, but we've made my partner and I have made accounts with the whole lot of them. And with Betterment, for example, the lowest risk thing or the highest risk fund you can get into out of the box is an 80-20 US stocks/bonds portfolio. In terms of risk, that's nothing, especially for somebody that's young and can take on a lot of risk. And then Robinhood, you mentioned retail brokerage platforms like Robinhood, eToro, etc. We think of them as a similar user base, but with a completely different value prop. With Robinhood, they're almost increased. So with Quantbase, we're trying to tame, standardize high risk. With Robinhood and the likes, it's almost like they're doing the opposite. They're trying to make it more chaotic because that's what makes them money. And with Robinhood, you pick your stocks. You pick. You kind of have to think about what you want to buy. You can gamble. You can do like low cost, DCAing into low cost ETFs, etc. But with Quantbase, you pick your funds, you pick your strategies, and then you let the algorithms do the work for you. And then finally, I want to talk a little bit about Titan, ARK Invest. They're like new age ETF platforms, portfolio robo-advisors. It's really interesting. We've gotten a lot of our inspiration for UI from Titan. They only offer 3 funds, and they have like 20 to 30 stocks in them total. The approach we're taking with Quantbase is very different. So right off the bat, at launch, we're going to have about 20 funds, and those range from like a Wall Street Bets tracking portfolio to a Nancy Pelosi kind of tracking one, these fun gimmicky ones, to much more buttoned up portfolios. We have one called the Single Index Leveraged In and Out. It comes from a really decorated paper, and it's been back tested back to 1928. And it has about like 19% annualized returns. And pretty much what it does is it jumps in and out based on an algorithmic signal of the S&P 500. And it essentially where it gets its why it's so valuable is that in the bull market, it gets like the S&P's returns, but leveraged. And in a bear market, it jumps out and invests into either cash or treasury tracking ETFs. And it's done quite well over the past almost century. And so with Quantbase, we kind of think of ourselves as the platform where you can invest into whatever kind of strategy you want. Going forward, we're looking to create like crypto index funds, yield farming funds, NFT portfolios, and so on and so forth, right alongside our equity funds, our algo trading ones, our quant ones, and so on. So you asked about the user experience. So what we've seen just from speaking to users and speaking to like just industry leaders is that especially in the business to consumer space, retail investing space, UI and like the user experience is what matters almost the most, right? Like that's what a lot of folks say is what got Robinhood ahead. And so that's what we focused on, like first and foremost. It's making it really, really easy to invest in quite complex to execute strategies. For example, like the Wall Street Bets tracking fund is pretty complex on the back end. It analyzes pretty much the entire Wall Street Bets community for sentiment, for upvote count, for like sentiment of the comments, et cetera, et cetera. And we package that into a super, super easy to understand fund that you can just read it and understand exactly what's going on behind the hood, and invest in it in one click. And so that's kind of the vision here. Lots of funds that you can invest into with one click. You can understand the theme of the fund and what it's doing, but you don't necessarily have to like care about what's being executed on the back end.
Awesome, thank you. Yeah, Lucas, if you have any questions, feel free to chime in here. But I guess I'll just ask a quick following-up question. Just very curious about the Nancy Pelosi index fund you mentioned. Yeah, probably not going to talk anything like political here, but just curious, like, how do you guys like build up this fund? Like, what's the technical aspect of that? Do you guys use like, web scraping, things like that to get the information from her Twitter?
So yeah, we do use web scraping, but so Pelosi is a House representative, and the Stock Act was passed, I think, in 2017, which essentially required all senators and representatives to publicly expose their investing data. So what that means is that all of Pelosi's like stock trades are public. Essentially, that's what we're using. It's a little bit more nuanced in the sense that they give away, like they're required to disclose up to 45 days after. So it's not necessarily incredibly fresh information that's posted to their data display. And the exact number of shares, the exact quantity of like money they invest isn't disclosed. It's a range. But what we do is we use that the data that we're given, and we have a little bit of an educated kind of opinion on that. Like when we create the algorithms, we look at the high end of the range for all the stocks that they invest in, and create our portfolio that way. A fun little insight from our current iteration of that fund actually is that Pelosi is invested about like 25% in Microsoft, which is crazy. Like she's got about like 15 stocks in the portfolio, and an entire quarter of the portfolio is Microsoft. About like 60 to 70% are like, high tech stocks.
Yeah, just jumping in here. Is that considered a high risk investment?
So yeah, we actually we have a risk score on our website that rates it from like 1 to 5 based on how risky our like algorithms and our qualitative opinion makes it out to be. That one is about at about a I think that's a 2. So it's generally lower risk, especially when you compare it to like crypto, leverage, NFTs, and so on and so forth. But at like a 15 stock portfolio, it's still quite concentrated, especially with like the concentration in Microsoft, Google, and I think WeWork. So they have quite a bit of concentration, and so that's why it's not necessarily like a 1.
Awesome, thank you. I guess we can move the topic a little bit. So, like recently we heard about all the news about inflation. Like the official number right now is like 6.8%, but I would say most people think it's probably a little bit higher. Let's just call it maybe like around 10%. So that's based on my like very superficial understanding. It basically means that if your total asset or your salary income is not rising more than 10% every year, then you're essentially like losing money.
Losing money.
So just curious, what are some of the strategies that especially young people can take to counter the inflation, and how could Quantbase maybe help them?
Yeah, that's a really good question. I'm going to look at the single index leveraged fund. That if you look at the backtest data, it's done quite well in high inflationary environments like the 70s and the early 80s. Obviously, that doesn't mean that like so essentially in that time period, it was invested in the S&P. And like, I think from what I read, like equities are a great like inflation hedge, at least compared to cash, in the sense that like you want to be invested in equities in time periods of high inflation. But every environment is different, especially in like every like high inflation environment is different, especially because we haven't had too many of them in the past. There's a number of things you can be invested in to kind of counteract the effects of inflation, like a very equity focused portfolio or a crypto one. I think the understanding is just that like anything outside of cash is usually good for inflation.
Yep, that sounds great. Thank you. So we will just hang out here for another 1 or 2 minutes while we do the conclusion here. So if anyone, including the host and the listeners, have any questions, feel free to just speak up or use the calling queue. So thank you so much, Som, for joining our show. We definitely learned a lot about high-risk investing. Just as a disclaimer, everything we talk about here is just for the purpose of information and entertainment. You should always do your own research before your investment and only invest the amount of money you can afford to lose. So, if you want to check out more about Quantbase, you can go to getquantbase.com. And I was browsing the web just a few hours ago, so you guys are doing a pretty significant overhaul of the website soon, right?
Yeah, so we just got our SEC registration a week and a half ago. So what that means is we can go from paper trading to live trading. So what we're doing right now is porting over all of our users that are on paper to live. That's a lengthy-ish process. So what that means is we've turned off new signups for the moment, but if folks want to get signed up, they can just reach out to us. We have a chat bar at the bottom of our site. So, check out getquantbase.com, see if there's funds that you'd like to be invested in, and then reach out through the chat.
Awesome. Thank you so much to Som and also my co-host and the audience. Wish you a happy holiday and hope to see you again soon next year. Bye-bye.